So in this session, we will look at the return on capital employed and the return on equity. But before we start calculating these ratios, let's first understand the difference between the equity capital and the total capital. Equity capital is the capital brought in by the shareholders of the company and includes the share capital and the reserves and surplus, which is the first two line items here. The total of this is what we call net worth or shareholders' funds. So when we talk of equity share capital, it is this net worth that we're talking about. Now the total capital, on the other hand, will, in addition to this equity capital, also include the minority interest and the long-term debt, which is the next two line items. The idea here is to take into account the entire capital with which the company operates. Now just to clarify the concept of minority interest, how this works is that when you consolidate the accounts of a company, it is done line by line, meaning that for each subsidiary wherein the parent company holds more than 50% of equity, the entire line item of such subsidiary is consolidated into the line item of the parent company's accounts. So this minority interest is that portion of a subsidiary's shareholding which the parent company does not hold or which is held by other than the company. Return on capital employed and return on equity are both used to measure the profitability of a company based on the funds with which the company conducts its business. While return on capital measures the overall return based on the total capital with which the company conducts its business, return on equity, on the other hand, measures the return attributable only to the shareholders of the company, which is why most investors look at return on equity extremely carefully. The formula for calculating this is fairly simple. For return on capital employed, you take the operating profit and divide that by the total capital employed multiplied by 100. And for return of equity, you take the profit after tax and divide that by the net worth, as we just saw, and multiply that by 100. Now, a company may operate with a very healthy return on capital employed, but it may not add much value to the shareholders if most of the income being generated is used up in servicing the company's debt or the interest charges. In that case, the return on equity or the return for the shareholders will be very poor. Let's just understand this with an example. Company A operates with a debt of rupees 800 and an equity of rupees 200 and a total capital of rupees 1000. Company B operates with a debt of rupees 200 and equity of rupees 800 and a total capital of 1000. Now you will notice that if both these companies pay a 10% interest for their debt, even though company B reports a higher operating profit and profit after tax figures, the shareholders of company A will earn a higher rate of interest on their investment. This is because company A operates with a smaller equity base. So in our case, the return on equity, which is what the shareholders earn on their investment, in case of company A will be 42%, while in case of company B, it will be 24.5%. So remember, while everyone hates debt on the balance sheet, it is actually a great way to increase shareholder returns, provided, however, the company can manage to generate a rate of return higher than the rate of interest which it pays to the bank, which in our example was 10%. Now at the end, let's just quickly go over a couple of very important points which you should keep in mind. When calculating the return on capital employed on a consolidated basis, the denominator denotes the total capital with which the company operates. Now, one way of looking at this is that this is done because the operating profit in the numerator represents the profit which was generated by the efforts of all the constituents of the company, including the minorities. So if you look at it on a profit and loss account, the numerator was this, which is the operating profit, and this was generated by all the constituents put together. Since these are consolidated accounts, each line item for every subsidiary was consolidated into the parent company, which is why in the denominator we have capital employed, which is the total capital employed. However, when you calculate the return on equity on a consolidated basis, the denominator will be the net worth. This is because in case of return on equity, what we're trying to measure is the return which is attributable only to the shareholders of the parent company. And that is why in the numerator, we take profit after tax and after minority interest in share of associates. So if we look at the profit and loss account again, what we take in the numerator in this case is this profit and loss for the year, and not this, which is profit and loss before minority interest and share of associates. So once we factor this in, what we have is the return which is attributable only to the shareholders of the company. It sounds a little complicated, but if you think about it, this makes perfect sense.